Health insurance. Now it's time to discuss health insurance. There's a lot to cover on this topic, so pay attention. Understand that health insurance relates to the cost of health care. Health insurance does not equate to health care. With that said, there are three types that I want to go over. There's private, which is provided through a company one works for. There's Obamacare, which are individual plans one gets on the open market if not insured through a company they work for. And then there's catastrophic. These are high deductible plans to protect one from major medical expenses. And by the way, you cannot use a government subsidy for these. In order to have insurance, you're going to have to pay premiums. These are the amount that the policyholders pay for the privilege of having health insurance, which usually are on a monthly basis. Premiums must be paid when due, regardless of whether they visit a doctor or use any other health care services. Generally speaking, the lower the deductible, the higher the premium, and vice versa. They could also vary because of your zip code, age, family size, and medical history. As a benefit, they may be tax deductible. Let's look at an example. Let's say you get a silver plan from Obamacare that may carry a $500 monthly premium before any subsidies are applied. Therefore, if one does not qualify for a subsidy, the annual cost for the privilege of this silver plan is $6,000. Then there's the deductible. This is the amount of expenses you pay before your insurance company starts to pay anything. In addition, it is also somewhat common for the health plans to impose a separate deductible that applies to prescription drugs. Thus, you have two deductibles to meet before your insurance company starts paying anything. For example, let's say you have an annual $1,000 deductible for your plan and you break your arm. Then you go to the hospital and it costs $1,500. You will pay the first $1,000 before your insurance company begins to pay on any of the remaining $500, which may be part or all of it, depending if you have a copay or coinsurance. So if you have copay, it is a specific amount you pay whenever you use a particular type of healthcare service, such as a doctor's visit. However, the copay will more than likely not apply to extra services such as blood work taken during the visit. Let's look at a couple examples. First, let's say you have a copay of $50 per doctor's visit. You see the doctor 4 times for being sick. Thus, the total you paid is $200 for all those services. Another example is, say you have a copay of $10 for generic drugs, and your doctor prescribes to you a drug each of the 4 visits. The pharmacy fills each prescription with a generic drug, thus the total paid is $40 for all the prescriptions. Then you have to worry about coinsurance, which is where you pay a percentage of the cost of health service, generally after you met your deductible. You only pay coinsurance until you met your plan's maximum out-of-pocket for the year. For example, let's say you have a 25% coinsurance for hospitalization. The insurance company pays the other 75%. You need an MRI, and your health insurance company has negotiated a discounted rate of $400 for the MRI. You have already met your full deductible of $1,000 for the year, and your maximum out-of-pocket for the year is $20,000, and you've only spent $1,500 year to date. Thus, your coinsurance cost would be 25% of the $400 discounted rate for the MRI, or $100. Now let's say the MRI comes back and says you have a tumor and you need to get a special drug to get rid of it. The special drug costs $10,000 and you've already met your full deductible for the year. Thus, your coinsurance is $2,500, 25% of the $10,000. If your plan uses coinsurance, you want to make sure that the bill is sent first to your health insurance carrier for any applicable adjustments, and then your portion is billed to you, as opposed to paying your percentage upfront at the time of service. Now, let's look at a copay and coinsurance together example. Let's say you have a $50 copay for doctor's visits, and then you have a 70-30 coinsurance for your hospitalization, where the 30% is yours. Your out-of-pocket maximum is $20,000, and you've only spent $2,000 in expenses so far. You've already met your $1,000 deductible for the year, and you get hospitalized. And therefore, you see the doctor 5 times while in the hospital. The hospital portion of your bill is $5,000. You're going to pay $250 in copays, the 5 doctor's visits at $50 a piece, and then you're going to pay an additional $1,500 For the coinsurance, that is the $5,000 times the 30%. So the total you pay is $1,750, $1,500 plus $250. So I've mentioned out-of-pocket maximum a few times. So what exactly is that? Once you pay this amount in expenses, your insurance company then pays 100% of future medical costs for the insured period. For an example, the plan has a $1,000 deductible and you have not used your insurance yet. You have 80-20 coinsurance where you pay 20% after the deductible is met. Your out-of-pocket maximum is $10,000. You go to the hospital for a heart transplant that costs $100 grand. You pay a total of $10,000. You pay the $1,000 deductible, and then you have $9,000 of coinsurance that you have to pay. The insurance company pays the remaining $90,000. I know all of this can be confusing, especially when you're filing claims in real life. So make sure that when you sign up for insurance, that you understand exactly what your insurance covers and what it does not. Ask your insurance company or broker questions on anything you do not understand so you do not have any major surprises. Now, I also mentioned subsidies when I was talking about Obamacare. Well, if you have Obamacare, you may be eligible for a government subsidy depending on how much money you make. A subsidy is a payment to you from the government to help cover part or all of your Obamacare insurance so you can find out if you're eligible if you get Obamacare. Now, let's move on to health savings and flexible spending accounts. What you need to know about these two. First, the health savings account. These are employee-owned where pre-tax dollars may be deposited and used to pay for qualifying medical expenses. Because an HSA belongs to the employee, any remaining balance remains with them if they leave the company. Any unused funds in an HSA can be rolled over from one year to the next, and the contributions also reduce your taxable income. However, the employee must participate in a high-deductible health plan to participate in an HSA. Then there are flexible spending accounts. FSAs are owned by employers, not employees, and they give the employees the opportunity to contribute pre-tax dollars throughout the year to pay for qualifying medical expenses. Contributions also reduce your taxable income for covered approved medical expenses. However, funds are not transferable if the employee leaves the company. In addition, FSAs also have limitations on the amount and timing of reimbursement. You got to use it or lose it. And if your company does not offer a high deductible health plan, an FSA is the only option you have. Here is a table that compares the two types of accounts. Now, I know this topic was a lot to digest, but this is going to be something that you have to deal with your entire life. So it's in your best interest to understand all this information.